Hello, everybody. This is Jamieson. Thanks for being on the webinar tonight. Thanks for being on time. We're just going to give it maybe another 60 seconds for some stragglers who are coming on, and we're going to get started. We're going to talk about asset-based long-term care and all kinds of good things this evening. Thanks for coming. Be back in about 60 seconds. Still have a few people continuing to stream on. We're going to get started in just about 40 seconds. If you came for Perpetual Wealth Systems asset-based long-term care program, you are in the right spot. We're going to get started shortly. Thanks so much. All right, everybody. I think we're going to get started now. We'll still have a couple people pop on, but we're already a little bit past start time. I want to thank you guys for joining me. This is John Jamieson. I'm with Perpetual Wealth Systems, and tonight we're going to present to you asset-based long-term care. We want to make sure your money goes to your family and loved causes and not Uncle Sam. And unfortunately, that's what a lot of people by default are leaving themselves open for, is the ability to lose all their money to either a long-term care facility or to the government. We don't want either one of those two things to happen. You know, the topic of long-term care can be a little bit depressing to talk about because it could represent, you know, the winding down of our lives and so forth. But I think we just have to understand that that's going to be natural for a lot of us, and everyone goes through it. But what doesn't have to be natural is that we go broke in the process, and we can go into those very later years. Now, by the way, long-term care can happen to young people too, right? Through accidents, so forth. But most of the time, it's going to be through the natural aging process and some kind of debilitating disease, et cetera, that we're going to need help in our later years. And no one likes to think about that, but I'd rather think about that and have a plan for it. And then if it happens, I know I'm okay, and I know I'm going to have enough money to pay for it and still leave my money behind to my family. So if that's what you're attempting to do, is to be able to handle those issues of long-term care should they occur, and for you and your spouse, and still leave money behind for your family, then you're absolutely in the right spot. We're going to show you how to do that tonight. So with that being said, let's get into it. A little bit about me. I think it's important that if you're going to ever listen to anybody and possibly follow some of their advice, that you kind of know what their background is. So I've got over 27 years as a businessman and investor. A lot of my years were spent real estate investment. I still do some of that, and I still teach people all over the country how to do it. Definitely where I got started. I now own a company called Perpetual Wealth Systems, and we're basically a cutting-edge wealth strategy firm. We've got clients in over 20 states. So just because you're not down the block from us does not mean you can't do business with us. And we do all kinds of non-traditional, both income creation, wealth creation, and wealth preservation strategies. Very proud. I wrote 2 books so far. I might do some more. First one's called The Perpetual Wealth System. My latest one's Wealth Without Stocks or Mutual Funds. Both were Amazon #1 bestsellers and continue to do pretty well out there in the marketplace, which I'm always happy about. Contributed many articles, been interviewed on a lot of radio shows. My articles have appeared on CNBC, Investors Business Daily, America Online, to name a few. I've been fortunate. I spoke to hundreds of events and trained thousands of people all across North America. There's almost, I don't think there's more than 3 or 4 major cities in the entire North America that I have not spoken in. So I've been very fortunate to get a message out to many, many people. I've got extensive experience in business, finance, insurance, marketing, and real estate. If you're looking to do something in any of those areas, I'm usually a pretty good source. And if I'm not, for whatever reason, if you want to know something that I don't know, I can promise you I know someone who does know the answer to whatever question you have. So I practice a team-based concept, which means I work with people, but really top people from all over the country in all aspects of what's on the screen. So I'm going to know a lot of it, but nobody can know it all. And I think that's what you have to understand at the beginning is nobody can know it all, but everybody can know enough to be an expert in a couple things and then bring other experts in to provide expert knowledge base to their clients. And that's what we do here at Perpetual Wealth Systems. And I've been involved with many millions of dollars of financial and real estate transactions. So I've been actively doing the things I teach for, a long, long time now. There's copies of my books. If you're going to pick up a book, this webinar is not to sell you a book, but if you're going to get one, get the latest one, Wealth Without Stocks or Mutual Funds, because I do cover most of the information in Perpetual Wealth System in a few different chapters in that book. And then there's 14 more additional chapters. And got huge, great reviews. The top of the book cover, I got a testimonial from Jack Canfield, You might not know Jack, but you'll know Chicken Soup for the Soul, and he was the co-author of that. So if you're going to pick up one of those books, please do. You can go to wealthwithoutstocks.com, or you can always pick it up at Amazon as well. All right, let's talk about long-term care. 70%, now this is according to Health and Human Services, 70% of Americans will need some form of long-term care. Right, now, what is long-term care? How is it defined? Generally defined by 6 basic functions of life. And those are dressing yourself, potting yourself, feeding yourself, transferring yourself, incontinence. Those basic things that most of us take for granted every day, there might come a time when you can't do at least 2 of the 6. And if that's the case, you qualify for long-term care. Now, long-term care could be administered at your house. It could be administered in an assisted living facility. And it can also be administered in a full-blown nursing home if need be. And obviously, cost spectrum is different for all 3 of those. But you have the ability to get care with most programs in any 3 of those venues. Now, here's a huge stat. 70% of us are going to need some form of long-term care. Over 30% of us are going to need extended long-term care. And we're going to talk about that here in a minute. But that's 30% of the population. Okay. Now, about that population, I don't have it up on a slide, but between now and the year 2030, which, just a little more than a decade, the age group in America from age 65 and above is going to double. There's going to be over 71 million Americans that are in that 65 years and above. And most of that 71 million have no plan for any kind of long-term care. We're going to show you how crazy that is when you consider everything else in your life. At the end of this presentation, we're going to compare not having a plan for that to not having a plan for your house burning down and cars wrecking, etc. Now, another big stat, from 2000 to 2015, Alzheimer's cases in this country increased by 123%. Nobody knows exactly why. There's all kinds of studies. Obviously we're going to live a little bit longer, but why is our brain malfunctioning so badly? Could be a ton of chemicals we put in it. Nobody really knows. They're studying it. They say they're making forward progress, but right now there is no cure for Alzheimer's disease, and it's massively on the rise. Additionally, 1 in 3 seniors that pass away will either have Alzheimer's or another form of dementia. So, think about that for a minute. 1 in 3 of us who reach the age of, in the senior group, 1 in 3 of us are going to pass away with some form of dementia. And a lot of that Alzheimer's and dementia would require long-term care because you forget to learn how to do the things that you take for granted. Forget to feed yourself, how to dress yourself, sometimes how to do your teeth, those kind of things. So you need help, and you want to be able to set it up in advance that you're going to be well taken care of and much less of a burden to our families. Now, one of the things we're going to talk about is the financial burden of long-term care, but there's also the huge physical and family burden of long-term care. And I know many of you listening to this will have already dealt with that, so you know what I'm talking about. Now, back to Alzheimer's. The average Alzheimer's patient has the disease, according to the Alzheimer's Association, for 8 years. Now, average for private care nationally in a long-term care facility right now is about $8,000 a month. Okay, semi-private, about $6,500 a month. Now, the average life of a man once they need long-term care is 2.3 years, and for a woman, it's 3.7 years. But it's important to understand what an average is. To get to the average of 2.3 and 3.7, there's people at both ends of the spectrum. So there's going to be people that live their entire lives, pass away, don't ever need 1 day of long-term care. That goes into the average. And then there's also people that are on long-term care for 15 years. Excuse me. Just heard about a lady that's on benefit now for long-term care for 15 years. And everybody else in between. And all those numbers create the average. So it doesn't mean that if you need long-term care and you're a man, oh, you just need to be ready for 2.3 years. Woman, 3.7 years. Now, who's average listening to this call? I don't know about you, but I'm not average with anything I've ever done. And my guess is you're not either. But if you do have to start from somewhere, those are average numbers. But remember, it's going to be people that don't need it and people that need a lot of it. So if you just use the averages, because we got to start somewhere, long-term care costs for a man would be $216,000. The woman would be $344,000. So both of them need long-term care. If a married couple both need it over their lifetimes, you're talking about $560,000 just for that. And folks, that's much more than most people's net worth, or certainly liquid net worth, just to pay for that. So it's going to be more than people have to be able to pay for that expense. And you know what most people are doing? They're just wishing and they're hoping that they don't ever have to pay for it. I'm never going to get sick. That's never going to happen to me. I'm never going to need long-term care. And yet, the national averages tell us something very different. A lot of us are going to need, in fact, more than most of us are going to need some form of long-term care, and a large portion of us are going to need extended long-term care. So the wish and a prayer, it's time we grow up and say that's not the way to plan for anything. Let's look at some other avenues where we might be able to handle this evil specter called long-term care. Now, if we are one of the unfortunate ones that has Alzheimer's, folks, if you're in a long-term care facility for 8 years, that's $768,000, and that's in today's dollars, right? You might not need a facility for another 10, 15, 20 years. It's going to be much more. So these numbers get kind of daunting, but those are what we're dealing with today, okay? Now, Medicaid or traditional long-term care insurance are not the only options. Now, Medicaid, we're going to talk about in a minute, but Medicaid was never designed to handle this massive aging population needing long-term care. So number one, it's struggling with money itself. Things have to be done to it. I'm sure you've heard that it's going to be insolvent along with Social Security and Medicare, et cetera. So-called quote-unquote entitlements, which frankly I don't think they are entitlements. Most of it we paid money into and we're expecting some kind of a benefit out. But be that as it may, there's a huge strain on those programs, and Medicaid's one of them. Now, there is a solution that could have a potentially unlimited term payout for long-term care. So if you happen to be in the average of way above the 2.9 or 3.7 years for the man and woman, you can continue to get a benefit and make sure that those expenses are paid by setting up a proper program. The other end of the coin is also true. If you don't use that particular kind of coverage, you're going to leave more money behind for your family than you had in the first place. And that's pretty powerful stuff. We're going to talk more about that a little bit later. So what options do we have? Is Medicare an option for long-term care? It's really not, folks. It's not designed for that. Medicare pays for large portions of our hospital stays, procedures, observation, emergencies, basically hospital stays. And then they will pay basically up to 100 days of skilled nursing care. Typically it's more like rehab care, 100 days once you get out of the hospital. But once you pass that 100 days, you better have another option, okay? Because now you're going to start dealing with long-term care and all kinds of expenses that go along with that, right? So it's really only for people who are improving and you're basically working on a rehab plan. You can get basically 100 days of that kind of thing paid for, but anything above and beyond that, you're on your own. Does not cover long-term care or custodial care at all. What about Medicaid? Is that an option for long-term care? Well, unfortunately, it's the default option. So if you're one of those people that wish and pray and hope, but you do need long-term care or your spouse needs long-term care, you're going to default to Medicaid. Now, before Medicaid will kick in and pay anything, guess what you have to do? You have to spend down all of your assets to pay for your care before they're going to kick in anything. So in other words, you must become a pauper for Medicaid to pay for care. Medicaid was designed for the lowest income people, lowest net worth people, to give them a safety net for, different things as far as medical goes, and all kinds of different things go in the Medicaid program. But it really was never designed to provide this really expensive long-term care. So they're going to make you spend everything you have. So I know I can't see you, but if you're listening to this, how many people have worked their whole lives or are continuing to work their whole lives? Many of you guys are still employed, but you're planning for the future. How many people work their whole lives to give all of their money back either to the government or to a long-term care facility and leave nothing for your family? Keep your hands up so I can see them. Right? Nobody's raising their hand to that. None of us are working for that. We're working hard to provide a great lifestyle during our lifetimes, and hopefully, if it permits it, to leave a nest egg behind for our kids, grandkids, causes, charities, those kind of things. We're not working hard to be able to pay for long-term care and give the money back to Uncle Sam, and yet by not having a plan, that's exactly what you're opting for by default, okay? Now, not only that, but if you do go on the Medicaid system, guess what? They're in total control of where you stay and the quality of care you receive. You know the old saying, he who makes the gold makes the rules? Well, Medicaid has the gold at that point. They are paying your way after they've made you spend down everything. Now, if you're married, they will allow the spouse to keep a certain amount of marital assets, but it's still very low and nothing that you want to deal with. And then if you ever need to go into long-term care, if the spouse does, that has to be spent down as well. So let's try to avoid that. Let's not be at the government's mercies. Again, how many people listening to this not only work their whole lives to give money back to the government or to a long-term care facility, but now you want to be at the tender mercies of Uncle Sam and be totally underneath his care. that's exactly what you're doing if you go into the Medicaid program for long-term care. All right. Now, there's another strategy. People say, well, I'm going to take everything out of my name. I'm going to put things in trust. I'm going to send things over to my kids. All of which, besides the morality of that, I mean, we are, in my opinion, we are supposed to pay our own way when we can. So to take everything out of our names so we can have Medicaid pay our bills, I don't agree with at all. But if you do, there's some things you need to know about it. Number one, now there's a 5-year look back. It used to be a 3-year. Now there's a 5-year look back. What does that mean? Well, if you need long-term care and you've moved any assets out of your name the previous 5 years, or you paid people, usually family members, to take care of you during that time, guess what? They're going to consider that still your money, and you basically got to give it back. All right, so they're not going for that, especially within 5 years. Also, a thing that's around that most people haven't heard of, called familial law. And now, I happen to be in Michigan, so I present a lot of this in Michigan. It doesn't apply in Michigan right now, but it does apply in 30 other states. You can do a quick Google search on your state to see if it applies. But what is it? It basically says that under familial law, the government believes that your kids should be responsible for your care. So even if you've put things into their name, and even if you got underneath the 5-year time frame, they're putting more and more things in there that they're going to be able to go after your kids and the assets that they either inherited or were deeded over while you were still alive. It's happened in Pennsylvania already, and I'm telling you, as that huge group of people gets to age 65 and above, you're going to see it happen many, many more, and you're going to see many more states adopt it because they're going to go after money because they're going to need it. So there's going to be a whole cottage industry, in my opinion, of going after people that have transferred money out of their name before they needed long-term care, and they're going after their kids and grandkids to get that money. So unless we want to set up our kids and grandkids to deal with, collections and courts and everything else, why don't we just have a plan in place that we don't need to worry about that, and we can still leave money behind for our family, okay? So again, you just have to become a pauper to get Medicaid relief. I'm not working my whole life to be a pauper. I don't think you are either. So with that in mind, maybe we want to start thinking about having a different kind of plan. Now, there's traditional long-term care insurance, and people have been using that now, probably the last 34 years, relatively successfully, but things have changed with traditional long-term care. First of all, when they first came out, the insurance carriers who were carrying them totally miscalculated the cost that was going to be involved with these policies. So at one time, just about 15 years ago now, there was over 100 carriers that you could choose from that offered long-term care policies of some kind. That's down to 15. So ladies and gentlemen, it's simple supply and demand. If you had over 100 carriers, that gave you a lot of options. If you're down to 15 carriers, what do you think happened to the pricing of those policies? Did they go up or down? Of course it went up. It went up strongly. And a lot of carriers still left the market, even with raising prices. They didn't want to deal with it. Like, hey, this is too risky for us, or this is not part of our business model. We're getting out of it. And of course, that really cuts choices down. Now, if you ever are going to get a traditional long-term care, make sure it's a state-sponsored plan, which basically gives you the ability to have asset disregard. Long story short, it means this. You've got a $200,000 long-term care policy, and you, in fact, do need long-term care, and the policy pays out its complete $200,000, and you still need coverage. Then you're going to start spending down to get on the Medicaid program. Government will allow you to at least keep the $200,000 of current assets that you have because you did try to plan for the future, and they're willing to compensate you at least a little bit. They're going to make you spend everything else, but whatever the long-term care policy was, you're going to be able to keep that. In most states, you always have to check with attorneys and make sure that's legitimate where you're at, but that's the general overall concept. If you are going to get long-term care policy, make sure it conforms to state-sponsored plans, okay? Beware of guaranteed rates. Now, premiums are very difficult to change once you have those policies on an individual basis, but they can change the group pricing, which is what happened. So if they start paying out more and more premiums between the ages of 65 and 75, which is what most of us need long-term care, that's what happened to premiums. They skyrocketed across the board, okay? So be very careful of guaranteed rates because your groups can go up. Class rates can be raised based on a class basis, as we talked about, all right? Now, most traditional long-term care premiums are kept by the insurer if never used. Very similar to your auto, home, life. So as an example, let's just say you're paying $5,000 into a policy for you and your wife, you and your husband. Let's assume the premium never goes up, which is Disneyland. It is going to go up, but let's say you're paying $5,000 a year. Okay, you pay that for 20 years. You paid $100,000 in. You have no growth of that money, and there's none of that money left. So let's just say you never use it, and you end up passing away. $100,000 or whatever the total premiums were, that stays with the insurance carrier, just like your home, auto, health, those kind of things. In other words, there's no equity in those policies. Okay. Now, sometimes you can purchase an inflation rider for future payouts to you. So as we went over earlier, private care is about $8,000 a month nationally. Those are today's dollars. 10, 15, 20 years, that's going to be very different. So you might be able to purchase an inflation rider built into those. But again, it gets more expensive as you do that, but those kind of things are available. All right. So the main thing you want to know is to have an idea of what it might cost when you need and your spouse needs long-term care, and kind of pick a target number. We can't plan for everything, but we can still have a really solid plan in place to be able to handle long-term care. So again, no cash values as you pay those kinds of premiums. You can't draw on that money during your lifetime for anything else. It's basically gone in the policy because there is no equity inside a traditional long-term care policy most of the time. Now, you could self-insure. So I'm very fortunate. I deal with a lot of my clients are high income, high net worth people. And, if you got $3, $4 million put away, you're like, I can handle this. And the truth is they probably could handle it. But why would you want to? Why would you want to put all that money at risk when there's such a better way to do it? Okay. So you're basically assuming all the risk of potential long-term care for you and your spouse. So when you pay for long-term care facilities don't want to know about assets. They want to know about cash. So you have to convert assets to cash to pay for those monthly bills. So whenever you need that, you're at the mercy of whatever the market is at that point, because most of that stuff's going to be tied into the market in some way, shape, or form. So if you needed long-term care in 07, 08, 09, guess what? You had to sell at the absolute tanking of the market, and it gobbled up your money quickly, and there was no need for it. Okay, so you could be forced to liquidate at far less than market value for quick access to cash if a lot of your money's in real estate. Well, sometimes it can take a little while to move real estate. Sometimes it moves right away, but generally it's you're not just going to go down and write a check. You're going to have to sell something, and that can take some time. So rather than have to do all that and do it in record time, why don't we just have a program set up? Okay. So if you're a high net worth, high income person, think of it this way: even if you could afford to spend $1 to $2 million in potential long-term care expenses, why take such a risky, reckless approach when there's better options? Okay. How do you buy most other insurance if you're a high income, high net worth person? You buy your house insurance, you buy high deductible catastrophic coverage. So if something happens to the house, I'll handle the first few $1,000, $5,000, $10,000, whatever it is, but then the insurance company takes all the rest. You pay much less in premiums for that, but you also have much less coverage, but you do have coverage. Even though you could probably self-insure your house, you don't. You could self-insure your automobiles. Now, you still have to keep some for liability purposes, if you get sued, etc. But if you didn't have a loan on your cars, you don't need the top coverage. You don't need any collision coverage. And yet, most of you with newer cars, even though you could self-insure those, you don't. What do? You take a high deductible, catastrophic, protect me against some lawsuits, protect me against a total wreck, and I'll kick in the first, $2,000, $5,000 of that particular policy. So my point is, even high income, high net worth people, they have insurance for different events. In those events, the chances of those happening are very slim, which we're going to cover in a minute, but the chances of long-term care are much more expensive, and the possibility of it happening are much stronger than your house burning down. So think about that for a minute. Why don't you approach long-term care the same way? Let's do something with maybe a high deductible. We'll put up some of our assets, but just a fraction of our assets. And once we're through that, then the insurance carrier kicks in and pays all the rest of it. That's the way to plan for long-term care. And what I just described to you is called asset-based long-term care. We believe it's revolutionizing the long-term care industry. It's going to continue to do so. And here's basically how it works. You're going to reallocate existing assets to a properly structured, asset-based, long-term care life insurance policy or an annuity. What is a long-term care life insurance policy? It's a life insurance policy or an annuity in some cases that's built to provide unlimited long-term care. Now, your average life insurance policy is not built for that at all, nor is your average annuity. That's why it needs to be in a very specific type of program, but they do exist. Now, you can invest one-time lump sum, or maybe you want to pay into it over 10 years, and sometimes you can even pay into it over a 20-year period of time. So if you happen to have, money sitting in CDs or the market or in savings account that's really not doing a whole bunch, and you want to really handle this long-term care problem, you can just do, sometimes a one-time shot, or sometimes you might do a one-time shot and then pay very little on an annual basis, which we'll talk about a little bit more, or you can fund these particular policies over a 10-year, 20-year period of time. Okay, now, with these policies, unlike a traditional long-term care policy, there's some big differences. Number one, you're going to have existing cash value and growth during the time before you need the long-term care. Excuse me. So as you put money inside the policy, you are generating cash value, and you're also generating growth because you're either getting a guaranteed interest rate or it might be tied to an index, who knows, depends on the product you choose, but you are getting some growth on that money during the time you're not using it, and if you need it, you can access it, the cash value in it, before you need long-term care. So what you can do is solve for how much monthly income you would need for long-term care, and we can tell you how much money you have to move over now or over a period of time to accommodate that. And these particular policies are going to cover two people in one, right? So it's going to cover you and your spouse, if you both qualify for it, which a lot of people are. These are easier to qualify for than a traditional long-term care insurance policy. So you're going to have both people covered underneath one policy, okay? Now, when the benefit pays out, we can structure this so the monthly benefit is payable for your entire lifetime and your spouse's, no matter how long you live. So a traditional long-term care policy generally only pays out for about 3 years, sometimes 4, but 3 or 4 years, that's it. So once you're past the averages, you're paying all that out of your pocket, or then you're going to Medicaid, all right? So we can structure it where, with a specific rider built into these policies, that the insurance company will reimburse you for long-term care up to the amount of money that the policy was written for every month for as long as you live. So let's just say it's $7,000 a month. The $7,000 a month benefit is for you and your spouse. So in a very unlikely scenario, but just to illustrate it so it's easy, what if both you and your spouse had to go in long-term care the same month? All right, in that instance, that policy is going to pay out $14,000 a month, assuming the cost is $14,000. They're going to reimburse you for whatever the cost is, okay, up to $7,000. So if you need long-term care and it's $7,000 a month, each one of you, the carrier is going to pay out $14,000. That's significant money, and that's going to be on a tax-free basis. You don't have to pay any taxes on the money that gets paid to you in the long-term care benefit. All right, now, that's going to protect both of you if you, on the one side of the averages, and you pass that 2, 3, 4-year time frame, you're going to be taken care of. Now, the other end of the spectrum, if you never need it, you never use that coverage, or your wife never uses the coverage, when you pass away, guess what? There's a death benefit, and your family is going to get more money than you put in the program, right? So in other words, somebody's getting paid out on these folks, unlike a traditional long-term care where you pay and pay and pay, and then they'll pay for a period of time, and that's it. Or if you never use it, you don't get any money back. This one, you're going to generally do a one-time pay and maybe really small pays after that, just to keep a couple things in force, but much less money over time, and they're going to guarantee that they'll pay that benefit for as long as you live, and they'll also guarantee that if you never use that money or you don't use all of it, so let's just say the policy you set up had a $250,000 death benefit, and you and your spouse start using that money for long-term care, you're going to spend the death benefit first, and when you spend through that $250,000, now the unlimited rider kicks in, and they're going to continue to pay that monthly payment to you and your spouse for as long as you live. However, if you don't use the original $250,000 death benefit, whatever's left in that will go to your family when you both pass away. So think about that for a minute. If you need it, you could have unlimited monthly coverage for as long as you and your spouse live. If you don't need it, you can actually take out the cash later if you want during your lifetime and close the policy down. You could do that. Kind of defeats the purpose. I don't think many people are going to do that. But if you wanted to, you could do that. But much more likely scenario is you never use it. You and your spouse eventually pass away, and you leave behind a nice tax-free death benefit for your family. That makes sense, much more sense than risking everything you have and having to go on Medicaid or self-insure and going through $1 million or $2 million if you need it for extended long-term care for a couple. So somebody's getting paid out on these things, folks. Either you and your spouse during your lifetime or your family when you passed away. So let me give you a real-life example. This is a married couple from Maryland, clients of mine, both 61 years old. going to reallocate $125,000 out of their existing portfolio. Right now, this is not their only money. They do have other money, but they're going to do that because that's going to buy them a $250,000 death benefit. But more importantly, it's going to buy them each a $7,200 a month per person for eventual long-term care expenses. So again, that's for both of them. So that's $14,400 per month. And that's going to be for both of their lives, no matter how long each one of them lives and needs that benefit. So unlimited time frame for both spouses. So the $125,000 buying the $250,000 death benefit, that's not unique. But the $7,200 per month for each one for unlimited for as long as they both live, that's different, right? Now also, $125,000 is going to grow. So if they never need it, they'll have more cash in there than they put in the policy. And when eventually pass away, $250,000 tax-free benefit goes to their family. So think about that for a minute. You can just reallocate some assets. Now also, if they didn't have the $125,000, a lot of people listening to this wouldn't have had that much. Now, how much they put in and how much death benefit is very much dependent on their age and health. So if you were setting this up at 51 years old, to get that same $250,000 death benefit, folks, you wouldn't need $125,000. It's going to be considerably less than that. Just like any other insurance, the earlier you buy into it, the more bang for your buck you get. All right, now, they could also be 71 years. They could be 80 years old, and we can set things like this up. Even if you're saying, oh, it's too late for me, I'm already in my 70s. If you're still in good health and you still have your cognitive abilities and you're in relatively good health. Now, remember, the 61-year-old couple, they take a little medication. They've got some issues, right, as a lot of 60-year-olds do, but they were still insurable, still able to get the policy. So don't think that, oh, well, I have this, I have that. Reach out to us and let's find out if this would work. Because if it doesn't work with a life policy, it will probably work with an annuity program. And we can structure something very, very similar with an annuity that has much easier qualifying for it than either a long-term care policy or even a life insurance policy does. Okay. So again, by just reallocating money, shifting over the 125, they now have protected themselves with up to $14,400 a month for the couple. If they ever need long-term care, they never use it, their family's going to get $250,000 or whatever's left. If they use some of it, let's say they use $100,000 of it for long-term care. Great, their family's still going to get $150,000 after they pass away. All right. So we talked about the coverages, the death benefit's going to go to the family. Now, think about what this does, guys. This is going to protect all their other assets. So let's say that couple has a couple $1 million. Rather than potentially risk it all and kind of, throw it on a crap table and hoping that neither one of them or both of them are going to need long-term care, they're going to be able to leave all their other assets to their family members. So just by reallocating the 125, they're protecting all the other money that they have. This is a higher income, higher net worth person who gets it. They're like, why am I going to risk $2 million when I don't have to, when I can just risk the 125? And if I never use the 125, my family's going to get $250. Think about that. It's really powerful stuff, guys. It's going to revolutionize the way people pay for long-term care. So I'm going to recommend you send this presentation to somebody. It gives their family members peace of mind. If they ever need long-term care, it's going to provide stable income. So if their family members need to get away for a while, it's tough taking care of people. I've done it. I'm sure a lot of you guys here have done it as well, and it's tough. Sometimes you want to get away and just relax for a little while, but sometimes you can't because there's no resources to handle it. Well, there is now. All right. So you can let your caregivers still have a life, especially if it's going to be your family members. Secures inheritance for your children and grandchildren. So you want some of your money to help pay for future education, to help pay to launch businesses, to help causes, charities. You're going to be able to do that instead of risking it all and giving it back to Uncle Sam or long-term care. Okay, so let's talk about ways to fund the asset-based policy. Basically, you can fund almost any way you want. Obviously, cash, savings from a bank, your CDs that are doing a whole bunch of nothing, right? You can use qualified money. In other words, you can use retirement accounts to do these. And we can do it without taking big withdrawals and paying the tax on all the money. A lot of different ways we can set this up. If you have money in retirement accounts, there's a structure to do this, very economically and efficiently. Obviously, income from your job or business. If you want to fund it over the next 10 or 20 years, got money from a job or a business, that's simple enough. You can use health savings accounts. You can use existing annuities. Now, your existing annuities are not going to be built to do this, but we can structure them in such a way and maybe roll them over to another annuity program that is built for this. So if you have some old annuities that are around and you're thinking about, hey, maybe I could use that money, well, maybe you could. Reach out to us. We'll find out. Okay. Brokerage account. Obviously, get money out of your stocks and mutual funds. Existing life insurance policies. Maybe if you have those, maybe those can be exchanged over, rolled over, or cash taken out of them, etc. Even home equity from a personal residence, investment property. The money's sitting there and not doing a whole bunch. Maybe you could do something like that. There's all kinds of different ways to fund it. Totally up to you, and we can help you with that. Now, here's food for thought before we part. Okay. Chance, now everybody listening to this, I would wager, has coverage on your home if it burns down. You also have coverage on your cars. All right, so let's walk through this for a minute. Nationwide, chance of a house fire is 0.08%. Chance of a total car wreck, 0.4% nationwide. Now again, this is built for Michigan. Average home value in Michigan is $144,000. It's going to be more in a lot of places, going to be less in a lot of places, but whatever it is. Okay. Average price of a new car pretty much nationwide is $35,000. So let's just take those numbers to be true, even in your example. So if your house burned down and had 2 cars in the garage with no insurance on any of it, you'd be out $179,000, but not really. Because remember, you still have a lot value from your home. So let's say you could sell that for $50,000. So you'd be out $129,000, which is a lot of money. But it's not near as much as long-term care is going to cost you. Really not even close for most of you. And the odds of you needing long-term care are far greater than your house or car burning down. So remember, from the beginning, chance of long-term care, 70%. Chance of extended long-term care, so actually a little over 30%. So again, if we just took the average cost for a woman in a long-term care facility, it's $344,000. So you're willing to insure everything up there to save $129,000, but you're not willing to set up a plan for the $344,000, and it has much higher rate that you're going to need, that $344,000 or a portion thereof. And folks, God forbid, if one of the ones or your spouse is one of the ones that needs long-term care for Alzheimer's, now we're talking $768,000. So many people are going to go off this webinar and do nothing with this, and it's too bad, because when you look at it, everyone listening to this has coverage. I'll wager on everything up there and more, and yet the true risk of losing with those things is very little, and even if it did, it's far less dollars and cents than the long-term care. And guess what? You can insure long-term care, and if you never need it, get your money back. You can't do that with the above, with the house and the cars. Okay. So with that being said, we're going to wrap this up tonight. Now, I don't think I built a slide on it because I'm usually doing this live. Okay, so this is a good time to bring this up. Now, if you're not here with me live, then you don't have the folder that I'm talking about. So if you'll email me, I will email you a digital copy of the folder that everyone gets when they do this live. All right, so email me at, just give me my Gmail address. It's John, John, D as in David, Jamieson, Jamieson, John D. Jamieson. And again, you've got to remember to get Jamieson right because it's easy to misspell it. It's my version of it is J-A-M as in Mary, I-E-S-O-N. Got to get them both in there. It's not going to work. So John D. Jamieson at gmail.com. And say, hey, John, I listened to your recorded webinar on the long-term care. Please send me the folder, and I'll send you that. I'll send you all kinds of cool information. And if you want to reach out to a phone call to the office, we've got a 24-hour-a-day, 7 days a week manned number. Call 586-944-0794, 586-944-0794. That's 24/7. Leave a message. Someone live is going to answer it. Leave a message. Tell us when's a good time to call you back, and we will do that. And we can run several different scenarios based on what you have, what you're trying to accomplish, where you live, what your age is, a lot of different factors. And both me and my client care coordinators will walk you through the entire process of deciding on which numbers make more sense, deciding on which way you want to go with, and then the application process and the funding afterwards. Again, so reach out to me, John D. Jamieson, Jamieson at gmail.com, and call the office if you'd like to do that as well. Happy to talk to you on the phone. We're going to do that anyways. 586-944-0794. One last thing before we break. This is a recorded webinar. The content is very important for people. you can see that, in the next little more than a decade, we have a train wreck going for long-term care, and a lot of your family members are going to fall into that train wreck. So if you like the information that you saw tonight, if you learned something different, you learned something new, please share it with your friends and family. Just send them a link and say, hey, listen to this. I think I might do something with it. What do you think? Hope this will help you, etc. Please get the word out there. We want to help as many people as we can. Obviously, it's our business to do that, so it's very self-serving, but I like what we're doing, and I like what we're setting up for people. I feel very good about it. And so it's not just about a dollar. It's definitely about helping as many people as we can. And with your help, we can do that. All right? So again, folks, I want to thank you for joining us tonight. Email me. I'll get you out all the other information that the people that got it live. I will send that to you, and send this link to 5 or 10 people that you love. And we'll look forward to talking to you soon. Again, this has been John Jamieson with Perpetual Wealth Systems. Thanks so much, and we will talk to you guys real soon.